welcome back. What was supposed to be a relatively easy and quick OPEC Plus decision on production cuts was anything but after 4 days of tense negotiations, the group, along with the G20, ultimately willing and able to agree on some major production cuts. Here's what the headline numbers show, despite the fact it can be a little bit confusing. OPEC Plus, 23 countries, agreed to a 9.7 million barrel a day cut for May and June. After June 1st, it goes to 8 million barrels a day, or I should say July 1st, then 6 million barrels a day for all of next year. But anything can be revised at OPEC's June meeting. Follow that? Well, that's clear compared to the G20. Now, the G20, and I'm going to call it the bank nations, Brazil, America, Norway, and Canada, really the key of G20. They don't have an OPEC. They don't have a national producer. They can't say you're cutting this and you're cutting that, but they can, through capital spending cuts, effectively show the market what they are able to do. So let's call the bank nations 3.7. What's the bottom line of all this oil math? You're looking at probably a minimum of 13.4 million barrels a day, which is about 13% of global production right now at 100 million barrels, being taken off the market. That's the headline number. However, earlier today, I had the rare opportunity to do an interview with the energy minister, Abdulaziz bin Salman, one of the sons of the king, with 30 years of experience in the global oil and energy markets. We talked today, and he said, despite the headlines, he believes because of higher production numbers, the OPEC Plus cuts are more like 12.5 million. Listen.
The number is way much bigger. It's 12.5 million barrels. My calculus is as follows. The 9.7 is true. We are doing 1.3 to bring us back to the 8.5. The UAE, this is as a result of our high production in April. The UAE is also coming by about 1 million. And I believe Kuwait is made also another announcement of they're coming down by about 500,000 more than what they were doing.
All right, that was part of the interview there. It was a long interview, by the way, and it should be up already. And if it's not, it'll be up momentarily on CNBC.com. If you're interested in oil and energy, listen to the whole thing. In the interview, one of the things I asked him, and I asked him directly, I said, do you believe that, or many Americans believe that what is happening is the Saudis going directly after and trying to destroy the United States shale market? In our interview today, he reiterated his position that that is not the case. If you do remember, or don't, back in December in Vienna, Austria, at the OPEC meeting, I asked him that same question directly about Saudis, OPEC, and U.S. shale. What is the fate of the U.S. shale sector?
Well, we like them. And we would welcome them to come if they can. I know by law they were not. But we were talking about a Good Friday in an Irish way. So it's also a Good Friday for our friends in Oklahoma and Texas and all those who are producing. We've been doing a good work for ourselves. But if it means that we are helping them, it would be a good adventure. I have lots of good friends in those parts of the States, and I would be more than happy to enjoy with them a dinner talking about how much we've been doing good work for them. It would be nice if we can hear a good word from them of some word of appreciation, not for me, myself, but for the good effort that we're doing on behalf of the industry.
They would love your $3 cost of production. Thank you, sir. All right, that was our interview, or at least question and answer session in the OPEC basement. Tim Seymour back in December. He reiterated similar comments saying, we're not trying to destroy the U.S. shale industry. Mostly, we're just trying to make everybody on a fair and level balance sheet.
Well, you know, it's hard to really know what the intent here is, and there's arguably some OPEC Plus producers, including Russia, that have every interest in also putting as much pain on an industry that before going into this was under a lot of pain. But here's what I'll say about the cut and what I think about the oil market and the impact on markets is I'll call my storage facility half full, using the metaphor. Obviously, they're way full. But I like what happened. And I think while it may not be enough, and I think demand fall off in 2Q will be more likely 15 barrels a day, I do think this really prevents carnage in the second half of the year. So I think we've seen the bottom in Brent, at least with all the other status quo that we know right now. I can't predict the future in terms of other ingredients here, but based upon supply demand and how oil, I think, overshot on the downside, and the religion that literally has consumed many different religions involved in the geopolitics here of what they have to do. It's not just about putting the U.S. out of business. There's a lot of other balance sheets around the world that are in trouble, and I think energy bottomed.
And Guy Adami, I mean, listen, their Saudi cost of production is about $3, but their social costs are higher. UAE, Kuwait, the same. Nobody is winning at $25 oil, are they not? I mean, that's the point. People can say, well, that's cynicism on the part of the Saudis. No way. They're not winning at $25 oil. The U.S. is certainly not winning. Nobody is winning.
I appreciate you asking those questions, and you have to take the man at his word. But what I'll say is nobody might be winning, but I think there are people out there that are more than willing to lose the battle to win the war. And you can tell me whatever you want. I mean, one thing we're still entitled to is our opinions. And my opinion is the Russians and the Saudis absolutely did what they did a few weeks ago, might be a month or so now, I lose track of time, to absolutely cripple our industry. And it comes to me, you know, it's no real surprise if you overlay the chart of when Saudi Aramco went public and then the subsequent move in energy. I don't think it's so coincidental. So I admire that you asked the question. I'll take him at his word for his answer. But if you don't think, watching at home, that the Saudis and the Russians don't want our oil industry to be crippled, I think you're reading the wrong book.
No, they certainly might want it crippled because we have been, Karen Feinerman, we have been the price maker over the last couple of years, kind of come out of nowhere from 5 million barrels a day to 13 million barrels a day. A lot of that, as we have talked about extensively, is fueled by debt. And there are companies who trade today that I'm confident in saying, and I don't want to editorialize, Karen, their equity will likely not exist in a year or two. But there will be survivors. Are you ready and willing and able to bet on any of these companies surviving this and ultimately maybe making themselves and investors $1 or $2 down the road?
Not yet. I mean, I agree. Bankruptcies are, of course, coming. It doesn't necessarily mean that there'll be a complete contraction at all in what we produce. But I'm sort of wondering, Brian, you can probably answer this better, that deal seems, you know, tenuous at best, and with the, you know, with it sort of phasing out rather quickly, it wouldn't be shocking to sort of see it not really ever get going. And so I'm wondering, with the oil here, is oil sort of saying we don't even think this deal is so great, but it's just bottomed out, even with a somewhat loose deal.
Yeah, demand destruction, Karen, your point's well taken. It's about 30 to 35 million, maybe 25 to 35 million barrels a day, so it's not enough. By the way, I asked him, could they get more aggressive at the June virtual meeting? And at the end of the interview, he said, yes. By the way, that interview, I think it's up on CNBC.com. Again, if it's not, it will be very soon. All right, coming up.